The stock market clawed back from a midday drop today. It came to the edge of its first bear market since the start of the pandemic. The S&P 500 ended 18% below the record high set in early January. A 20% decline would have been considered the beginning of a bear market. The Dow erased a 600-point drop earlier today, ending just barely in the green at 3 o'clock our time. The stock market has been taking a beating lately, but it's even worse for crypto investors.
Some are swept up in selling risky investments due to worries about high inflation and rising interest rates. And there's a lot of investor uncertainty after a coin called Luna, which used to be among the top 10 most valuable, became nearly worthless last week. Joining us this afternoon is Assistant Professor of Finance at the University of Texas, Michael Sockin. Thank you so much for joining us. One of the big promises to investors was that crypto would be a better alternative to centralized banking, able to withstand inflation and stock market volatility, but this crash has investors worried. So how does one protect their money?
Oh, thanks so much for having me on. So I look at that question as kind of having three parts. First, is crypto really an alternative to centralized banking? And to that, I would say it depends a bit on where you are. If you're in the United States and you have well-developed banking and access to payment systems like Visa or MasterCard, maybe it doesn't make so much sense for you in that case. But for other places like Nigeria or Venezuela, where you have a less developed banking system, you might be more concerned about your money, then perhaps it is a bit of an alternative. So is it an alternative to centralized banking? Kind of depends on where you are. Second, can crypto withstand inflation and stock market volatility? Well, the narratives I've heard remind me a lot of narratives you would have heard in the early 2000s about commodities. Back then, people said that commodities would be a hedge against inflation and didn't really move with the broader market like the S&P 500. But as investors learned back then, and as we're learning now, that doesn't need to be the case. So crypto is behaving a lot more like a conventional asset. In many ways, it's very speculative. And to the third part, what should investors think about for crypto in their portfolio? Well, it's becoming much more like a traditional asset, and it should be evaluated accordingly. It has its own risk profile. It may be attractive for some investors, but as we're learning, maybe you don't want to hold it in your portfolio as a hedge anymore.
Well, where do you see it all heading? What's the future of crypto?
So what's the future of crypto? I wish I knew, but I do have some thoughts on it. So it reminds me a bit, and I'll use another example going back to the dot-com bubble in the early 2000s. Back then, you had a lot of narratives, a lot of hype and excitement and innovation in that space. And then at some point, we stepped back and we said, which of these companies actually do have value, and what are the best applications for the internet going forward? And I think that's kind of where we're going to be in crypto. Right now, we're not quite there yet, but I think at some point we're going to need to take a pause. There's a lot of innovation, a lot of new exciting things going on, not just with payments. There's also, peer-to-peer lending being done on the blockchain and a lot of talk of decentralization. But at some point we're going to have to step back and be a bit more deliberate and think about which applications are most appropriate for crypto and move a bit away from the speculative type.
Blockchain, crypto, it's all household names now, so we certainly appreciate the attention given to that. Assistant Professor of Finance at the University of Texas, Michael Sockin, thanks so much for joining us.